It's challenging, I think, for the investors out there. The maintenance costs, the insurance cost in particular, and of course the council rates just bang, bang, bang. I'd certainly expect house prices to go up. I mean, where they sit on average at the moment is basically exactly where they were 4 years ago, so early 2021. My outlook is for the economy to improve. When does that lead to people's feelings about the labour market changing? When do people feel a greater amount of job security?
Kia ora and welcome to Shed Lunch, brought to you by Sharesies. I'm Helen Mattison. Today on the program, we take a pulse check of the property market. Will more interest rate cuts revive house prices that have been down more than 20% in some regions? Or will investors and sellers be disappointed? Independent economist Tony Alexander has been mulling over the numbers and the sentiment. Before we dive in, here's some important information for you to consider.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Tony. Great to see you in person in the studio for the first time.
Yes. No, it's good to be here in person rather than just down the remote camera from Australia sometimes.
That's right. Let's get into it then. Interest rates are on the downward cycle, and I know you've said before that you think the cuts that we're having will finish or bottom out mid-2025. Last week, the Reserve Bank did what we thought it would do, and they reduced rates by 50 basis points, so we're 3.75. Anything in that monetary policy statement which accompanied that announcement has made you think differently from where the bottom might be?
Well, previously I thought maybe 3.5% would be the bottom, but the Reserve Bank, first of all, they brought forward in time by about a year when they see monetary policy reaching its bottom, and the low point they've got there is either 3 or 3.25%. In the document it says 3.1%. Well, we're not going to get 3.1%. It's going to be 3 or 3.25. And I think they've given a strong benefit of the doubt to the upturn they see in the economy not really driving much inflation. So maybe 3.25%, I guess, is where I think we're going to see the bottom for the official cash rate. And chances are that's going to be around near the middle of the year.
Mm-hmm. So similar to what you thought before.
Yeah.
What about house prices though? Because there seems to be quite a bit of optimism out there that this downward cycle in rates will actually lift prices, which, as we know, have been down. They've been 20% in some places. What's your view on where house prices are going? Because you have said at one stage they could even go up.
Yeah. I certainly expect house prices to go up. I mean, where they sit on average at the moment is basically exactly where they were 4 years ago, so early 2021, when we're already seeing a bit of a surge with the pandemic and very low interest rates and LVR's gone, etc. Just recently, when I look at the data from REINZ in particular, it seems to me they're not really going anywhere. Quite frankly, we saw a bit of a movement upward late 2023 with the first home buyers going into the market, and then that sort of faded away. And again in 2024, we saw a bit of a movement upwards around about the middle of the year, July, August, etc., when talk arose of interest rates going down. But that sort of faded a bit over summer as well. So for the moment, I'd say the market is flat, but I would expect, yes, interest rates going down, people rolling on to low interest rates, free up a bit of cash. It's going to be, I think, when people have a bit more confidence about their jobs, the labour market improving. That's maybe more when it's reasonable to think about we're going to have a long string of, small increases each month coming along.
There does seem to be, maybe anecdotally, a lot of listings out there at the moment. And I do wonder whether it's about sellers readjusting their expectations when it comes to price, because it would appear that it's a bit of a buyer's market and that sellers really maybe can't get what they thought they did. Look this week at Ryman Healthcare, the retirement operator that's listed, and that's going to raise another $1 billion in capital. And one of the reasons they said they were doing that is that people that were thinking about coming into the retirement village hadn't been able to sell their houses at the price they liked. So they've deferred coming in. So Ryman's got extra stock that's empty. So yeah, I just wondered what your perspective on that was.
Yeah, well, if you look at the data from realestate.co.nz, they have total listings sitting around about 33,000 at the moment. That's up about 18% from a year ago. Compare that with under 14,000 in the middle of 2021. So it's quite a change from back then. I guess what I'm perceiving in the housing market now is that there are more people willing to sell. That's what happened in 2023. The first buyers went into the market, the first-time buyers. Some of the investors moved into the market, and then a lot of investor sellers, they stepped into the market, and we saw a similar sort of thing last year. And so there are a number of people who want to sell, get on with their lives, etc., but it is definitely strongly a buyer's market. In my survey of real estate agents, I've got a net 40% of them saying it's a buyer's market still. And when it comes to the vendors willing to capitulate, too many have memories of where the prices were, 2-3 years or so ago. So a lot of them still aren't willing to discount, to meet the market and get on with their life, whether it be retirement or shifting, etc. So there could easily still be a little bit more downward price adjustment in the very near future, but I think it's more going to be the buyers coming back into the market later this year as the employment situation looks better. But certainly the vendors are out there. Yeah.
Where does that leave the investors then? I mean, perhaps because the prices are depressed, there's some, not so much bargains, but there's some reasonable pickings.
Yeah, it's challenging, I think, for the investors out there because the cost of running a rental business is now so much more than before. The maintenance costs, the insurance cost in particular, and of course the council rates just bang, bang, bang. Everyone around the country being told, well, this is what you're getting this year, like in the Hutt Valley there. I think Lower Hutt, it might have been 15% they're getting this year, and plans are for the same next year. Bang, bang, for a few years after that. So that just changes the dynamic, and the investors have to think, okay, costs are going up. What is my ability to get extra rent coming through? Not good at the moment. I've got about a net 21% or so of landlords in a survey that I run saying it is very difficult to get a good tenant at the moment. A year ago, a net 20% were saying it's easy to get a good tenant. So for the investors, I know I see some commentary out there, people saying we see the investors coming back into the market as buyers. I think that flow is relatively small out there. The bigger change is the investors as sellers. So again, in my survey of the property investors, I have about a net 14% of the landlords saying they're looking to sell. Now, the last time that measure was positive, as in more looking to buy than sell, was about March of 2023. And the proportion saying they want to buy, gross number, it's unchanged, about 21%. So 21% of the landlords saying, yeah, I'd like to buy. Same now as a year and a half or 2 years ago. What's changed is that back there early 2023, I only had about 20% saying I'm looking to sell. Now it's 35%. So this is the change in the investor market in the past sort of 12 to 18 months. More of the investors are looking to sell. The numbers don't quite add up for them, and they're not expecting rapid capital gain in the near future. So that to me is the main change out there. Not necessarily any great change in investors buying. There's more investors looking to sell and maybe put the money somewhere else.
Tony, when you say investor money is probably going elsewhere, do we have any inkling on where that might be? Is it listed property trusts? Is it even commercial property, which I think has come back a little?
Well, certainly people have had a strong interest in commercial property for the past 3 to 4 years. With the residential market moving backwards, investors were looking for something different, and they're having to learn about earthquake ratings, etc. out there. There has actually been relatively good demand from tenants for commercial property, or more essentially in terms of upgrading. A lot of businesses, they need to boost their productivity, they need to look for cost savings, etc. So there's a lot of restructuring happening in the logistics side. The warehouse over there doesn't work any longer. You need a bigger one over there, meaning you can close 2 of the other warehouses. You want something maybe near one of the motorways, etc. There seems to be a lot of construction of new commercial buildings in that regard. The demand for office space has sort of shifted towards strong support for the prime stuff out there, not so much for the lower grades as yet. But yeah, there's actually been strong interest for the commercial property, I think, for some time. I guess the relevant thing there is that when interest rates go down, the interest in commercial property goes up. My view is that interest rates going down that are relevant to the commercial property investors, 3, 5, 10-year interest rates, we're probably just about near the end of those interest rate falls. So I don't necessarily think commercial property demand is going to rise all that much over and above what you'd naturally expect with the economy starting to improve this year.
If we look around the country, it does appear to be a bit of a mixed picture if we think back to the residential property market. I think in your surveys of real estate agents, it looked like Northland was still a bit subdued. Auckland has a ton of listings. I think Bay of Plenty was coming back a bit strongly. Hawke's Bay similar. Wellington still in the doldrums. South Island, a bit of a bright spot. What's your view on that picture?
Yeah. Regionally, it is reasonably diverse. Christchurch, I think there's good economic support in terms of the tourist numbers. There's still recovery to happen there. Rejuvenation of the CBD, rebuilding of it, etc. The affordability of housing is a big positive as well. So I've long had a positive view on Christchurch/Canterbury. And when I say Canterbury, South Canterbury, of course, with the dairy payout being pretty strong. So that's going to be positive for your Ashburtons, Timaroos, etc., offsetting some of the freezing works lost down in Timaru, for instance. In Auckland, there's an oversupply of townhouses, and that's sort of dominating the market and people's thinking at the moment, especially out the West Auckland direction or northwest. And it's going to take a while for that to run through, and part of that running through is then there will be a further decrease in townhouse construction, and it'll set the scene for maybe it's 18 months from now. People will look around and go, not too many spare townhouses, maybe we need to build some more, and then there'll be a lag in building some more over 2026. So that cycle is going to be interesting for Auckland a wee bit further out. Christchurch maybe has a little bit of oversupply of some townhouses in the CBD, just a little bit there. Wellington, people have to be careful. There's Wellington City, and then Lower Hutt, Upper Hutt, Kapiti Coast, and back towards Porirua. For Wellington City, there are challenges. Under Labour's government, we saw the number of public servants go up about 18,000, and obviously a lot of them are losing their jobs now. There's clearly going to be more restructuring/redundancies in the public service. The government has to address its $17 billion deficit. There's extra money going to have to clearly be allocated for defence as well. And so that is going to keep Wellington depressed for, I think, quite all of this year, quite frankly, and maybe into a bit of 2026 for the city, but not necessarily the same for the Hutt Valley and up Kapiti Coast. There's just so much development going to be happening up there. Transmission Gully motorway in place. And of course, the expressway getting extended to north of Levin as well, so have a positive view there. Waikato, Taranaki, they're going to benefit again from the dairy payout being relatively good. Not that I have any particularly divergent view on New Plymouth. There's just always a good solid underpinning there, quite frankly. Yeah, Tauranga may have to wait till there's a bit more strength in Auckland, and then the usual sell your house in Auckland, get a good price, retire across to Tauranga. That engine will start chugging away again, but it's not really doing it at the moment.
Let's think about mortgage holders. I mean, I think at least half have fixed at quite short terms, so we're talking 6 months and 1 year. With rates nearly bottoming, people are probably thinking, what do I do? And do you think we're going to see a change to those longer term rates? That said, this week there seems to be a bit of a war between ASB and Westpac. That 2-year rate at 4.99. What's your thoughts? Well,
when Westpac for 2 weeks had 3 years at 4.99, I jumped up and down and said, now that is what I would take, basically. And it didn't. The other banks didn't jump in. It didn't last. And so, I see the competition is for the 2-year period. If I had a mortgage at the moment and I was thinking, I'll get a lot of it repaid in the next 2 years, I personally would probably take the 2 years at 4.99%. I see no great benefit any longer. Personally, it's sticking floating 6 months, 12 months. Those rates will come down a bit further. Do I think people need to hurry? I don't see the upward leg of the monetary policy cycle starting again until maybe late 26, maybe 2027. But that's the next shift in the market in terms of thinking about interest rates. It's all been monetary policy's easing, it's easing. Eventually it stops easing. Oh, that's going to be later on this year, second half of this year. Okay. I wonder when it goes back up again. The market's not really there yet. When that happens, you'll probably start to see some upward movement in the 3 to 5 year wholesale borrowing costs for the banks and those interest rates rising. That might be a story for next year. Most people, being Kiwis, are only going to fix for 2 years. 3 years, a few will jump in there. Even when the 5-year rate was at 2.99%, hardly anybody fixed back then and from 2020 to 2021. But most people are probably going to be reasonably happy in the 2-year period. And what's going to happen? Take ourselves 2 years from now, so that's 2027. Interest rates might be going up by then, so that's the difficulty. You fix 2 years at the moment because it seems to be pretty attractive. Your rate's going to mature right when there's upside risk on the interest rates coming forward, and then you're going to have a bit of a problem. So that's one reason I was such in favour of 3 years, 4.99. Maybe it comes back again, and again, I'd probably say that's what I would personally go for.
So a conundrum for people fixing longer or shorter.
Yeah.
It's almost like timing the market.
Sometimes something sticks out and you say, well, I don't really have a view on where rates are going to go in the near future, but this one seems quite good. And that was the 2.99 5-year one from 2020-21. And I think, like I say, close to 5% or just under for 3 years. I mean, if there was a 4 or 5 year rate, I'd probably take that at 4.99% if one of the banks was going to offer that. They probably won't, because the competition where people are looking is more in the 2 year time frame, quite frankly.
Yeah, and that's hence why I think ASB and Westpac have done what they have.
Yeah.
And also that seems to be one of the few moves. Most of the rate moves since the OCR last week is floating.
Yeah, well, floating is really closely tied to the cash rate. It goes up, goes up. If it goes down, the floating mortgage rate will come down. The 1 year fixed rates will also tend to move, but once you get out further along the yield curve, this reflects expectations of where the market is going to go. And the reason we haven't seen like fresh cuts in 3, 4, 5 year mortgage rates is because the markets had already factored in that the low point for the cash rate isn't going to be 2026 or 27, it's going to be the end of this year. So the Reserve Bank merely validated what the market had already moved towards. And that's why most of us are now thinking we are probably at the low point in the cycle for 3, 4, 5 year fixed rates, bank borrowing costs and the mortgage rates. 2 years, there could be a little bit more downside, but I really think it's going to be pretty limited from here.
With those longer term rates too, isn't that what the geopolitical kind of world economy and the effects that it has, isn't that more something that affects those rates than those shorter term ones?
Yeah, most definitely. If there's a big shock out there, then the Reserve Bank will respond one way or another to that. And of course, they expressed a lot of uncertainty in their monetary policy statement about what's going to happen in the world economy because, well, none of us know exactly what is going to happen. You think to yourself, okay, if tariffs go up, there's more inflation. Oh, interest rates would be higher. But if tariffs go up, maybe that depresses world growth. Oh, that means less inflation. That means interest rates go down. You just got to take it as it comes, quite frankly, see what's going to develop out of all of this. So there is a lot of uncertainty for the whole interest rate structure still out there. If we're looking ahead at where interest rates are likely to go in the very near future, I certainly think it's reasonable to expect that come the next review, April, I think it's early April, they will cut by, I think not half, but 0.25%. And then there's probably one more after that. So whatever that is, 6 or 8 weeks after early April. I guess where I differ from many others is that I don't think they'll take it down to 3%. I think they'll get to the 3.25% and pretty much say that's probably going to be it. But again, the uncertainty out there in the world we're living in, Trumpian politics, economics, international environment, we're just got to hang on for the ride, quite frankly.
Let's jump back to construction and consent. So that's usually a bit of a litmus test as to how things are going. I do note that renovations seem to be back in vogue. Can you tell us a bit about that?
Yeah, that's interesting that in my monthly spending plans survey, one of the, I think there's only 2 areas which have shown much of a change recently. One is a few more people are thinking about buying a house to live in themselves. I think that's the first home buyers still looking to take advantage of the opportunity out there with not much competition from investors. And the other one is that things are still relatively depressed in terms of people saying, I'm going to buy a motor vehicle or appliance. But for the home renovations, there's definitely a strong upward trend which has gone through there. And maybe for some people, it's a feeling of there's a few more tradies out there now because house building is falling away. There's a few more people offering their services, electrical, plumbing, carpentry, etc. So there's an opportunity maybe to get some of that work done without having to pay an absolute arm and a leg in order to get it completed and run the job. The risk the job's not going to be done for quite some time if they shoot off to something that's going to pay better in the near term. So I think it's that. It's also the case, I think, that there's always the older generation out there looking to improve things heading into retirement or fresh into it. And it looks like some of them are deciding, look, I've waited long enough, let's just finally get this place looking okay. But it is a bit of a surprising thing there. It is an area of spending growth.
Bathrooms and kitchens predominantly, rather than great big new housing, it does sound like.
Yeah, I think so. Yeah, it's a bit of an upgrading of the existing stock or the places that people already own out there. I don't think my survey there is capturing people saying renovations, oh, that's the granny flat I'm putting out the back. I don't think they're including that particular item in there.
Tony, just with construction, let's unpack that a little more. What are the dynamics there?
Yeah, the dynamic would be that when you get residential real estate turnover of existing, used houses picking up, it eventually leads to the number of consents being issued for new houses to be built picking up. And we've seen a bit of an increase in real estate turnover. That's about 72,000 in the past year. A year and a half ago, it was 58,000. So yes, there's an upward trend, but it's relatively mild. And given the oversupply of townhouses which sits out there, and developers have put some of these properties into the rental pool, and once they see the housing market moving, they're going to offer them up for sale. It's going to keep things constrained into sort of 2026 there. I think the townhouse construction keeps going down into 2026, and the finance requirement, pre-sales, that sort of thing. Whereas for individual standalone houses, I'd see that rising before the end of this year. Sort of just a combination of not so much of an oversupply in that market, and just the effect of the interest rates easing off coming through, and the labour market perception starting to improve as well. But it's going to be a different dynamic, townhouses versus standalone.
And is there any areas in particular where you think construction will be more buoyant?
I suppose, again, on Christchurch, I've got a positive view there. The population movement that is happening down there for affordability reasons, all the growth we see down at Rolleston, obviously in particular, but also north of the city with the Northern Corridor opening up there. So that's definitely positive. Outside of that, again, up the Kapiti Coast with the expressway network is very positive. Also an ageing population looking to retire up there if they can find the land. There is actually a bit of a shortage of land in some areas up there. For Auckland, there's going to be expansion up the northwest area for the next few decades, quite frankly, but that's where the oversupply of the townhouses is, and where some of these negative stories are around of they get so roasting hot, you're having to run your AC to cool the place down. So, us Kiwis, when we have a house building boom of some regard, it's like something always seems to go wrong. It's either leaking, or in this case, just getting too hot in the upstairs room. Too many windows, quite frankly.
Let's look at inflation. It's always a big bogey, and it does feel, from what the Reserve Bank has said, that things are in check, 2.2%, and that's kind of their main mandate. You've talked a lot about cyclical inflation, which, as I understand it, is almost a natural phenomenon. When there's a recovery, when there's an upturn, you're probably going to get a bit of inflation. You've always warned that that's probably around the corner and not as far away as we think. Have you changed your mind on that?
Yeah, no, still definitely got that view. I think some of the upside risk is greater because of the risk of tariffs going up, for instance. So no, I'm still of the view, and what I look at there's a number of things. One of them is the ANZ's monthly business outlook survey. On average, since 1992, inflation has averaged 2.3% since then. On average, a net 26% of businesses have said, in the next 12 months, I'm going to increase my prices. That was 82% net 2.5 or so years ago, so that was horrible. Inflation, 7% or so. That got down to net 35% in the middle of last year. It's now gone up to a net 46% of businesses saying, I'm going to increase my prices in the next 12 months. Not now, but when the opportunity presents itself. So that says to me, when the customer flows are stronger, because businesses have got compressed margins at the moment, and because many of their costs are still going up, when the opportunity presents itself and they think I can get a price increase away and people are still going to keep buying my product, they're going to do it. And I guess maybe I see some of that from later this year and especially in 2026. Not at the moment, unless you're a council or electricity company or oligopoly generally, or monopoly in the case of a council. But that's my perception of the risk further out. Now, the Reserve Bank is not focused on that for the moment. That's something I think that they'll be looking at later this year. In America, there's a little bit of a look at it for their economy. But it's a focus I see coming a bit further out. And look, if it looks worrying, you'll get the longer-term interest rates and the medium-term rates going up before the end of this year. We'll just have to see how that pans out.
So mortgage rate relief at the moment, but it could be that we're going to be paying more for goods and services.
Eventually, I mean, the inflation rate is going to go up. And this is one, I guess, a big problem for the investors, of course, because one of the key area of inflation, where it's coming from, and their cost increases, is the rates. Maybe not so much the insurance premiums. There's a wee bit of a plateauing going there, but the council rates going up. They've got a monopoly. There's nothing you can do about it. And so that is affecting, I guess, for a lot of older people, their thoughts about what can I afford to spend in retirement? Can I even afford to stay in this same house? I would expect eventually that leads to some people downshifting out into the regions because they're going to be able to free up some cash in order to pay the pay the council rates. And for some of the generation below them, the middle generation, older than the kids which are going to Australia, for some of them, increasingly the answer is, and this is just one factor in there, I'm following my kids to Australia. I've got a neighbour doing that. They're selling up and following their two kids across to the Gold Coast. So that generation, the late 30s, 40s, early 50s, they go, I'm out of here, man. That is a new phenomena out there in terms of some population loss for New Zealand. And some of them would have been people who might otherwise have been thinking, time to prepare for retirement, let's get an investment property. No, they're not going to. They're going to look at, going overseas.
But look, you often spend quite a bit of time actually in Australia. You've got property there yourself. What are the pickings there? Is it better to be trying to buy property over there if you want to have that asset?
I've got no view on that. I mean, I'm not a property investor myself, so I've got no idea about what's a reasonable yield or anything like that. The Australian market, you've got to be careful because the rules vary from state to state. Like in Queensland, as a foreigner, even as a Kiwi, you'll pay an extra 10% sort of stamp duty, 3% local stamp duty, and then an extra 7% foreigner buying situation. It varies in the other states, but first of all, you need to talk to a lawyer or accountant over there, figure out what's going on there. And just be aware there is quite a difference between the top 8 capital cities and the regional towns. It's dynamic, which is more volatile than we have in New Zealand. They talk about sea change, people retiring to be near the sea side, or tree change. They're going out into the countryside to be near more trees. And that dynamic is quite different from in New Zealand because the countryside here is not really all that far away from our main cities. So people definitely need to do a bit of research over there and don't always assume that the places are going to be greatly cheaper, especially if you're looking at one of the major cities. Sydney is vastly expensive, for instance. So do your research.
Also, we've had changes here or about to happen with foreign buyers. I wondered whether that had any effect or because it's such a high net worth situation that it's all too early to have any idea.
Well, given New Zealand First is in the governing coalition there, and they're opposed to reopening the housing market generally, if we get any easing up, it's only going to be for the more expensive houses out there. It's really not going to be relevant for the housing market of interest to 99% of people out there, quite frankly. I don't see that one really coming along and causing an extra whoosh upward in our housing market. It's just not going to happen.
Other factors are migration. We've talked a little bit about the fact that the brain drain, our best and our brightest are going to Australia and probably buying there and probably not coming back. Their parents are following them, as you've just said. What about people coming into the country? And that usually has an effect on the property market, doesn't it?
Yeah, usually, but we've got to be careful because we've had this period of weakness in the housing market, even though we had, like in the year to October 2023, a record net gain of 135,000 people. So the correlation is not necessarily as strong as people think. When people talk about a correlation of, the net migration numbers driving Auckland in particular, people used to always talk about that. Well, that's usually only if the market is rising already and they go, market's rising, I wonder why. The net migration is strong. And they grab onto that. But most migrants coming into New Zealand, they're not going to be able to buy a house for a long period of time. They've probably got no money. They're coming into New Zealand because they've got no money and they can get a job and build their life and their family, starting up anew here. So, there's probably X billion, 2-3 billion people overseas who, if you gave them a ticket, would be on the plane tomorrow and come across to New Zealand. From an accommodation point of view, it would have upward pressure on our market. But in terms of house buying, It'd depend if we buy the properties to go and rent to them would be the main dynamic there. I've proven, I think, to myself from over 30 years ago, and I reckon the other economists have reached the same conclusion, you cannot forecast net migration flows in New Zealand, not even 6-12 months ahead. You cannot do it. So we take these things as they come.
Tony, keen to find out what your outlook for the year is now that we've had another cut and possibly we'll have some more, but it's not just about interest rate cuts, is it?
No, there's more in the mix there. There are definitely some positives for the New Zealand economy. The Reserve Bank are predicting the economy will grow about 0.6% a quarter from here on out. Possible, I think they could be a little bit optimistic, but you got the positives of the interest rate pain easing away and disappearing. That's completely different from saying there's an interest rate boost coming along, which is more your pandemic period, GFC, that sort of thing. The dairy payout, so that's positive for the dairying regions, not so much of an impact on the rest of the country there. World economy, neither here nor there too greatly, I think, in causing too much to happen there. Construction, infrastructure, it's a slow burn to improve, so that'll be a stimulant, but it's incremental over a long period of time. Commercial, I definitely see some positives here on the commercial construction side. House building, standalone houses improving later this year. Townhouse construction just falling straight lining away, I think, to some point in 2026 is going to be a restraint on growth. I think there's scope for a few more foreign students to come into New Zealand. On the tourism side, I guess maybe the government's new campaign will drag a few more people into New Zealand. It's got a lot of publicity overseas, so good on them. It doesn't boost the productivity in our economy. It doesn't boost our income per capita at all, just more people serving in the cafeterias, cafes, etc. But overall, my outlook is for the economy to improve, and I guess my focus will be mainly when does that lead to people's feelings about the labour market changing? When do people feel a greater amount of job security? I'll be able to see that straight away in my real estate survey, because I ask the agents and they're right at the coalface and they'll see it. I'm thinking that is sometime in the second half of this year, and that will then, I think, flow through to the housing market, putting in a better performance. But for the moment, while I've still got about a net 51% of the agents saying, people are worried about their jobs, a gross 51%, it's just going to keep a bit of a dampener on the housing market for the first half of this year.
Thanks, Tony, for coming in and joining us in the studio today. And thanks everyone for joining in. You can watch Shared Lunch on YouTube or follow the podcast on your favourite podcast app. Leave us a rating and tell us what you'd like to hear next. Mā te wā.